It was a pretty quiet day for U.S. stocks up until the final hour. At that point, we did receive some news that there was going to be an easing of some of the restrictions from the Volcker rule, and a lot of the financial stocks shot higher. By the time it was all said and done, the entire stock market was up over 1%. Now, after hours, we did see a lot of those same financial companies start to fall a little bit as we found out some additional dividend restrictions going forward. So we'll see how that plays out tomorrow. But in the meantime, we had a nice little pop higher for most of the sectors. The only sector that finished in the red today was the utilities. So we'll take a look at all of that, see what it means for our posture. Then we're going to get into a trade application example that I would deem to be a pretty speculative and risky stock, but we will be looking at selling a put on it that would require the stock to fall more than 50% for us to lose money in the next 2 weeks. So as long as you think that the stock won't fall more than 50%, then it's a trade that could potentially make some profits for you. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's June 25th, 2020. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe while you're there. Check out our description area where you can sign up for our email distribution list. We're also heavy users of Twitter. I would encourage you to follow me at Brandon Van Zee as my handle. Also, we really appreciate those of you that click like and retweet on these Market Outlook related posts over there on Twitter. Lastly, we do have a presence on Facebook as well. Feel free to join us at that group you see in the web address in the logo in front of you. All right, let's go ahead and jump into our charts. And as you can see, I've got chart 6D pulled up here in front of us. And I usually start with this particular chart if we have a move of at least 1% in either the upside or the downside. And today was one of those upside 1% movers. S&P 500 was up 1.1% by the time it was all said and done. You can kind of see the effect, the kind of different visual to kind of understand whether we've been having extreme ranges or small ranges in our most recent trading history. And with this green bar right here taking us up and over that blue horizontal line, that reminds us that that is a 1% move. It's our first 1% move since back here on June 16th. Now, of course, we have to remember that just yesterday we had a sell-off of more than 2%. So can't get overly excited about this day, but at least the bulls didn't just simply lay down and roll over. It was a situation where we actually saw the bulls kind of going forward and trying to trample right back over the bears, and that tug of war continues. We'll talk about that here in just a little bit when we talk about our posture as well. But just a reminder that the types of volatility that we've seen here in just the last 3 or 4 months has been absolutely extraordinary. All of these massive green and red candles, it seems like a couple of them every week, if not more in some cases, whereas prior to that we had a very sleepy and quiet period where there were very few 1% days. So if you didn't know it by now, we're in a very volatile market, and that is being accounted for in the VIX. The VIX closed at 32 today, so it did drop a bit. Naturally, when the stock market goes up, the VIX tends to go down, and that was the case today. But most of you are aware that 32 would be considered quite high historically. Most of the time that we've been in this bull market for the last several years, the VIX has found itself below 20. At this point, at 32, of course, it's worked its way down from where it was here at 85 when the true fear and panic was taking place in March. So it has been winding its way lower, but it's still a long ways to go before it gets to 20 again. So for those of you that are premium sellers, like we will be with our trade application example later tonight, a high VIX can actually be a benefit to you, particularly in an environment like this where you start with a high VIX and it continues to meander lower over time. Let's go ahead and take a look at our normal 4 grid now. And so for that, I'm going to pop on over here to chart 4B. For those of you that are premium members following along at home, remember all of our premium members at Market Scholars have access to all 50 of our customized charts that you see David and I use. So for this one, we'll go over here to chart 4B. And as that gets pulled up here, a reminder of what we're looking at. Each one of these charts that you see is 3 months in length. Each one of the candles is 1 day in length. Underneath each of those 4 charts that you see there is a technical indicator called the market forecast. That's something that is only available over at TD Ameritrade, and in this case, their Thinkorswim platform. It's a stochastic type of technical indicator. In other words, it can only go to 100 and it can only go down to 0 and everything in between. And there's 3 main lines that we're looking at. The green line is called the intermediate line, as you can see kind of color-coded here in the green label. The blue line is called the near-term line, and the red line is called the momentum line. Technically, there's a 4th line involved as well, called the market sentiment line. It's this dotted orange line that you see here. The calculations are slightly different than the other 3, and it goes back and tracks a much longer period of time. So we don't really reference it all that much because it's not overly useful for more active trading, at least compared to the other 3 lines. So when you're looking at these 3 lines, note that the red line, the momentum line in this case, is the one that has the most sensitivity. It's the one that you're going to see go up and down the fastest and the sharpest from one day to the next. The next most sensitive is that blue near-term line, and then after that would come the green intermediate line. So when you hear David and I talk about our postures using the market forecast technical indicator, unless you hear us state otherwise, we are referring to the green line. In other words, what is our intermediate posture right now? Think in terms of weeks to months, in terms of that time frame that an intermediate line is trying to track here. The near-term line would be days to weeks, and momentum would basically just be days. So unless you're a hyperactive trader, you're probably not going to be using the first 2. If you're trying to catch a general trend, then that intermediate posture would probably be the most important to you. So with that out of the way, you'll now see that there is a background color associated with each one of these charts over the current candle. And the only one that looks different from that perspective is the NASDAQ composite, and that's the chart in the lower left-hand corner here. This chart background you can see is still green, whereas when we look at the candle here for the S&P 500, notice that pink background. We have a pink background over here for the Dow Jones Industrial Average, and then also down below for the Russell 2000. So what that is telling us is that the green intermediate line down below in the market forecast technical indicator for 3 out of those 4 charts is currently considered bearish. Now we do divide up bearish and bullish with 2 different categorizations, either strongly or weakly. And the good news is right now all 3 of those bearish postures are just considered weakly bearish. If it ever does go to a strongly bearish posture, the background color will change from kind of this lighter pink like we see right now to this darker pink like we saw back here during the crisis moments in March and April. So right now we would have a bearish intermediate posture, but it would be considered a weakly bearish intermediate posture on the S&P 500, the Dow Jones, and the Russell 2000, whereas the NASDAQ composite continues to have a strongly bullish posture. Now note that the intermediate line is currently falling on the NASDAQ as well, just like it is on the other 3, but what makes the NASDAQ different is that its current reading is at 89.50. You can see that right here in the label. So as long as this green line is in what we call the upper reversal zone, so if I were to right-click on this chart and go to maximize the sell, you can kind of see this a little bit better when it's blown up into the full screen. You'll notice that this green line is falling on the NASDAQ composite, but because it's in this what we call the upper reversal zone, in other words, its reading is above 80 on the market forecast, we consider that to be strongly bullish. So we give it more flexibility, a little bit of a grace period there to kind of work itself out. And generally speaking, that is useful. For instance, back here in May, you saw that the NASDAQ's green line was trending lower for several days right here when you got hit with this little bit of a 1-2 punch there with the selling those couple of days. So the green line was trending lower, but notice it was still in that upper reversal zone. So that would not have been an excuse to take bearish NASDAQ-oriented trades or to sell out of your bullish ones that you had previous to that. You're basically allowing that flexibility to say, yes, I understand there's going to be a little bit of selling here or there. That's a natural market for you. But because it didn't drop out of that lower or upper reversal zone, you continue to kind of ride that wave higher. And of course, that ended up benefiting you as prices went much higher than those levels right there. Now, you did see that there was a bit of a head fake here about 2 weeks ago, when the chart color on the NASDAQ composite did switch from green to red. And the reason for that was you can see that the green intermediate line fell out of the upper reversal zone at that time. It was just slightly below 80, and it tried to find some stability on the chart and was able to accomplish that. And so it only stayed in that kind of weekly bearish zone for a couple of days, 2 or 3 days, and back to a bullish posture again. So all of that leads me to say that this still seems to be a market that has a tendency to want to go higher. The NASDAQ officially has a bullish posture, but the other three I wouldn't necessarily count out. And the reason I say that is they are all three trading above rising moving averages. That's another thing with these chart setups that are helpful from a visual perspective is you can look at the most recent color on the 30-day moving average to determine if prices are above a rising moving average. If the tip of the moving average is colored green, like it is here as an example with the Russell 2000, that means that price is currently above a rising 30-day moving average. Now, yesterday you saw that the moving average was colored yellow there briefly for one day because yesterday the Russell 2000 fell and closed below that rising moving average. If you ever are trading below a falling moving average, that moving average color will turn red like you saw back here. So when you're thinking about things in kind of broad generalizations and you ask yourself, okay, what's the path of least resistance? Where is the trend of the market right now, regardless of what a posture may be, with any individual technical indicator? Remember, there are hundreds of technical indicators out there. The market forecast is just one of them. So there will be plenty of times where each one of those technical indicators will give you kind of conflicting signals. And so another thing to simplify your trading might be just simply looking at what's going on with something like a 30-day moving average. And in this case, we do have some bullishness to report there because in all four of our charts, we do have price above rising moving averages. However, it is the NASDAQ composite that would be considered the leadership group of this market right now because it continues to have the strongly bullish intermediate posture using the market forecast technical indicator as well. All right, let's move on and take a look at some other charts here. Let's look at the 1040 crossover method. And on this particular chart, we've identified this a couple of weeks ago, but it's worth reminding just in case some of you haven't been in every single one of our presentations. We do have a bullish crossover that has taken place on the S&P 500, and that's somewhat recent information. It just happened here a couple of weeks ago. These charts that you're looking at here on chart 4C are 3-year charts. Each one of the candles represents 1 week in length. And so you don't get signals all that often here because you're talking about large portions of time. The smaller your aggregation period, the more often you're going to get trade signals. The longer your aggregation period, the less often you'll get trade signals. And so that latter description would be represented here with these 3-year weekly candle charts. So it is worth noting that something reasonably recent happened here with the S&P 500, and it is a bullish consideration where the orange line, which is the 10-week moving average in this case, and that's an exponential moving average, rose above the blue line, which in this case is the 40-week exponential moving average. Exponential moving average basically just means that it's putting more weight and more emphasis on the more recent price action as opposed to the price action that was occurring 30 weeks ago. So anyway, we do have bullishness there from the S&P 500, which is a great sign since that is kind of the most widely tracked equity benchmark on the planet. Now, remember that the NASDAQ composite has already been a leadership group. You can see that the NASDAQ is up and away, and has been for the last several weeks. In fact, the crossover on the NASDAQ took place way back in the first week of May. So it was leading the rest of these groups by a long shot. So it's just more of the same out of the NASDAQ composite, where we see a lot of those kind of work from home types of stocks continuing to blast higher. I noticed, for instance, Zoom Video hit a new all-time high here today. That's one of the stocks that we're trend trading in my Monday top-down trend trading class for my premium students, and many of you are probably involved in that stock as well, ticker symbol ZM. And if you're not involved in the stock, you're probably involved in its business. I know I have been as a teacher that's had to or a parent that has become a teacher would be a better way to phrase that here during the coronavirus era. And those of you that are parents of small children at home, you know what I'm talking about there, because a lot of these digital school classrooms are being held through Zoom. Now, valuation probably is a bit of a stretch and a concern here, but nobody can deny that trend, and it was yet another all-time high here today for Zoom, and that just kind of represents the typical stock there from the NASDAQ composite, I guess you could say. Let's take a moment to pop on over here to the internet for a second. Wanted to show you here on our factor selector that I use for my Wednesday factor-based swing trading class that we did have a change up at the top. Momentum stocks are once again the leadership area. And remember that plays directly into the strength of the NASDAQ composite I've just been sharing with you here in the last 10 minutes. Many of the momentum stocks of our day are NASDAQ composite types of stocks. Think about stocks like DocuSign, which is another one of our big trend trading stocks that we've had. Teladoc is another one. Those are stocks that are in the NASDAQ composite. Remember, a lot of the stocks that have 4 letters in their ticker symbol or are technology oriented oftentimes find themselves in the NASDAQ composite. Stocks like Microsoft are in there as well. That's been doing quite well. Apple, of course, has been doing well. So point is, a couple weeks ago, it looked like momentum was starting to slip a little bit. And at that time, the stock market seemed to have a little bit more of an interest in some of those beaten up financial stocks and industrials, and even some energy had a little bit of mojo there for a little bit, some oil and gas. It seems like that has now swung back to the more traditional stay-at-home types of stocks that have been working, really ever since the start of this whole coronavirus. So I wanted to share that with you guys here to make you aware that momentum finds itself back on top again, and I think that supports that conversation that we just had about the NASDAQ composite, generally speaking, being the leadership group of this market. Also, while we're over here on the internet, wanted to remind those of you that are premium members of Market Scholars of the exclusive question and answer session that David and I teach for our premium members. For our trading rooms, Plus members have access to all of our trading rooms, but we only invite the premium members to our question and answer session just because it doesn't scale all that well. You can imagine that if we're spending 2 hours in a classroom, we wouldn't be able to answer endless amounts of questions in that time. So we have to kind of limit the amount of attendees there. So we limit that to our premium members. But if you're interested in hearing my take on some of these topics, that recording is now posted and available for you in our Trading Rooms calendar. Claire asked me today about Discover Financial's business model, and of course I brought up our long call trade that we have going here for this market outlook video that we've more than doubled our money on. In fact, we were close to, if not already at a triple at its best part of that particular trade. So Claire wanted me to take a look at Discover's business model as more of just a buy the stock dividend growth investing candidate. Eva then asked me about New Jersey Resources as a kind of unheard of gas utility company, to see if that had some appeal for dividend investors. Mary then asked me what my thoughts were on Berkshire Hathaway and if this is a good or a bad time to buy shares of Berkshire Hathaway. So we gave her some statistics on price to book and determined that if you were to back out the value of its equity investments and its cash, that all the rest of its businesses were worth about $80 billion, including Burlington Northern, which has a very close competitor in Union Pacific, and Union Pacific's market cap is $110 billion. So in other words, Berkshire is looking quite interesting at these levels. Paul had a question about, what sorts of sections within the annual reports on the various stocks that he owns should he be reading. Emil asked me about some of our nice doubles that we've had in the stock market, including Starbucks and Procter & Gamble and Target, and what were some common elements, if anything, that we could try to find future stocks that will double. We then had a question from Dwayne asking if there was a way to hedge a dividend growth investing portfolio. And then lastly, Krishna asked me about a REIT, a public storage REIT, PSA, and if that has any interest for dividend investors. So feel free to check that out if any of those topics are of interest to you and you are a premium member of Market Scholars. Lastly, thank you to those of you that clicked like for me the last time we did a market outlook video. Here it looks like 139 of you clicked like, which is awesome, way over that 100 like level that I generally am shooting for. So thank you for the additional 39 of you that came out of the woodwork to support this particular presentation. Remember, David and I don't get paid anything to do this particular video here. So what we hope to accomplish with it is give you some interesting education and knowledge for free. In return, we're hoping that you will help us promote our business where we actually do make money on the premium side of our classes. So if you scratch our back, we'll try to scratch yours and vice versa. We appreciate your support there on social media. All right, let's get back on over here to some charts. And let's start traveling on over to some 12 grids now. And for that, we're going to start with the asset class 12 grid. This will be chart 5A for those of you that are following along at home. And as you can see, the background colors of these charts will be either green or pink. And if they're green, of course, that means that you have a bullish intermediate posture. And if they're pink, it means you have a bearish intermediate posture. So as you're looking at this here, you can see that we've got a mix, and that's typically the case on this first set of 12 grids because this is not all stocks. It's a mix of things, commodities and bonds and different things like that. So let's take a look at the various charts here and see if there's anything that stands out. One area, as most of you are aware, if you've been listening to this presentation for the last several months, that I've been a little bit more excited about than not, has been gold. And gold continues to look pretty good. It hasn't been as strong recently as it was during that April time period. Nonetheless, I think the path of least resistance for gold continues to be higher. It was basically flat here today, but I wanted to point out that in the last week we saw some real progress on this chart. You can see that we clearly broke above our prior horizontal resistance area, and even though the last two candles here have been red, both of them have remained above that breakout zone. Sometimes you'll have a breakout and a failure. It'd be more of a head fake. That's not what is taking place here with gold. You had a breakout, you had a little bit of stalling action the last couple of days, but you've remained above that breakout zone, and that is a sign of strength. You can see that the background color of GLD continues to be dark green, telling us that we have a strongly bullish posture as that intermediate line is at 91 and rising right now. So I still think there's some good opportunities out there, and we've taken advantage of Newmont Mining and the junior gold miners and gold fields and even GLD itself as various trade examples that I've done for you in these videos here over time. I continue to think there's opportunity in gold and the gold mining space, so keep your eyes open for those opportunities there. In terms of other charts that I think look pretty good right now, foreign bonds look pretty good. We use BNDX as kind of our proxy to see what's going on with foreign bonds. And you can see there's been a consistent uptrend in foreign bonds there. And note that there is a pretty big difference there compared to the chart to the left, which is long-term U.S. government treasury bonds, which has had more of a downward tilt to it. Now, we are trading back above the moving average on TLT, so there has been some bullish progress made there, but that's more of a reversal candidate there, whereas foreign bonds themselves have been more of an ongoing trend situation that's taken taken place there. Oil was up today, up about 3% there, and we are above a rising moving average with oil. On the top rung here, I would say that stocks in general look reasonably strong. They're not quite as bullish as they may have been a few weeks back, but nonetheless, the path of least resistance continues to be to the upside. Today, we did see a robust move out of foreign developed stocks. They were up 1.42% today, which easily beat the 0.42% out of the emerging market stocks that are out there. But you will see that the emerging markets have done better on a 3-month look-back period. They're up about 18.7%, whereas the developed stocks are only up about 17.9%. However, it does look like the EFA is setting up for a nice bounce candidate off of that rising moving average, whereas some of you might feel there's too much separation between the current stock price and the moving average on EEM. So for those of you that are looking for a bounce trade, maybe EFA and some of those foreign areas that are developed like Japan, Australia, much of Europe could capture your attention. Let's take a look at the sectors now. As I mentioned in the intro, we had a good day from a sector perspective. The only sector that was down today was the utilities, and for most people, having the utilities down is not necessarily a bad thing. Generally is a sign that the market is willing to assume risk if they're willing to throw the utilities away and move into everything else. Now, you can see one day does not make a trend, and one day does not change a posture either. So despite 10 out of these 11 sectors that you see here closing higher today, most of them remain with a bearish intermediate posture according to the market forecast technical indicator. The two exceptions to that are communications and technology. For those of you that attend my Monday top-down trend trading class, that should not be a surprise to you, as those two areas we've focused on for a very long time at this point. In fact, technology remains number one on the sector selector as well. So they both fare pretty well here in this case with the market forecast posture setting mechanism as well, and they're both above rising moving averages. Remember that communications is quite similar to technology these days because communications basically extracted all of those big internet companies out of technology a couple of years ago. So, your Alphabets of the world and, your Facebooks of the world, those types of companies are now part of communications. So anyway, you will oftentimes find that they are cousins to one another. Their charts will look quite similar to one another. Right now, I would probably give the slight edge to technology. You can see its intermediate line is at 86, whereas communications is at 80. Remember that technology is driven at the top by Apple and Microsoft, and both of those have been workhorses. And so it just seems there's been a little bit more of a consistent experience there with technology. But communications, obviously a very strong trend there as well. In terms of those areas that are struggling a bit more, you can see that three of the charts on the board have that darker pink shading, and that is energy, healthcare, and utilities, and all of them are below moving averages. Now, interesting, all the moving averages are rising, which is why the moving averages are yellow. In this case, price is below a rising moving average, so there's more of that neutral yellow color on the moving average itself. So right now, we'll see if that allows them to catch a little bit of support. But for the time being, those are the areas that if you're looking for bearish setups, perhaps you can find some opportunities right there. In fact, one of the bearish trades that we have going on right now in my factor-based swing trading class is a utility stock that we've been short the last couple of weeks and done reasonably well on. So there could be some opportunities out there for you. All right, let's get into our trade application example here today. And for that, I'm just going to come on over here to chart 4A. This is our market forecast 1 grid. And I teased this at the intro by saying that it was a highly speculative situation that is going to require the stock to fall 50% in just the next couple of weeks. In fact, it's really just the next week. So might be of interest to some of you. Then again, once you see which stock it is, you might not have any interest whatsoever. Let me go ahead and pull it up. And it is ticker symbol INO. This is Inovio Pharmaceuticals. And this is a stock that is right in the heart of the treatment for coronavirus, or at least the hope of that in developing a vaccine and all of that. So this is a stock that has been in a trend for quite some time. You can see 3 months ago it was a $6 stock. Eventually started working its way up here to around 15, kind of double top there around 15, stabilized around the moving average, and then in the last week has absolutely gone ballistic, where it's gone basically from 15 to where we find ourselves right now at 31 in just 4 trading sessions. So without a doubt, this is one of the hotter stocks in the market right now. It was up 30% just today alone. And some of you might be looking at a situation like this and saying, man, I missed it. Is there anything I can do to turn back time? And while I can't provide that sort of a time machine for you, what we can consider doing is an option strategy known as selling puts. Now what that allows you to do is to develop a marker on the chart where you would be a willing buyer of a stock. Let's say you missed a breakout and you really wish you could go back in time and buy it at that breakout zone. Well, in this particular case, $15 seems to be a pretty substantial level. You can see right here, we had a double top around $15 or $16, and you can see $15 right now is about where that breakout took place just 4 sessions ago. Coincidentally, it also happens to be exactly where the upward trending 30-day moving average is right now. So normally you don't get an opportunity to say, okay, well, a stock just went straight up. I want to buy that stock if it were to fall 50%. Most companies don't really have much in the way of options premium to offer to you if you're saying to the market, yes, I'd like to buy that company for 50% off. That's asking a bit much in normal situations. But this is not a normal situation. This is a highly speculative healthcare type of a stock, and it's a situation where sometimes easy come can also mean easy go. So you have to be a little bit more cautious with it as well. But as I come on over here to the trade tab, you will see that if I open up the July 2nd weekly contract, so remember, next week's a weird week because we have the 4th of July holiday here in the United States, and so the stock market won't be open on Friday, so options, the weekly options will actually expire on Thursday next week. So you really only have to be in this trade for a week, and you can get some very acceptable reward. If I'm coming over here, first of all, I'm going to show you that the implied volatility is over 300%, which is an astronomical number. If you're buying calls and puts, that could be a very dangerous thing. If you're selling calls and puts, then you're technically selling some extremely high-priced options. And usually when you're the seller of options, you like to sell them when they're high-priced, and if you're going to buy them back, you'd like to buy them back when they're low-priced. So we don't necessarily mind that. It's just worth pointing out for those of you that aren't used to seeing such large implied volatility numbers. That large implied volatility is the entire reason why selling the $15 put is still a very reasonable situation in this case, where you would require the stock to fall more than 50% from $31 down to $15 before you would be forced to take ownership of that stock. In return, you're going to make about 2% return on risk on this trade. Normally, when I'm selling puts, I'm looking for a 1% return on risk. And usually, if I'm lucky, the stock might be able to fall, let's say, 10%. This is a case where the stock can fall 50%, and I'm going to make double the normal amount that I typically would with big blue chip safer types of companies. So without a doubt, there is risk in this situation, but if you feel lucky and you think to yourself, okay, all I have to do is hope that this stock does not crash 50% in 1 week, then you would make money on this trade. Now, if worse comes to worse and this stock does actually crash more than 50%, you are on the hook for having to buy that stock at $15 per share, but that goes back to what I was showing you on the chart. Some of you are kicking yourself for not buying this at $15 per share just 4 days ago anyway, because that was when the breakout really started to happen. So it's a little bit more of a gamble, a little bit more of a speculative trade, but might be worth it for some of your circumstances depending upon what your goals are and what you're hoping to accomplish with your own paper money account. So let's go ahead and place that trade. I'm just going to click on the bid price in this case, where it says 25 here, and I'm just going to do one contract here because it's paper money, but obviously feel free to change that to however many contracts that you can afford. Remember, each contract would require you to buy 100 shares of stock at $15. So really it would just be a $1,500 outlay in this case with one contract, not a big deal. For some of you, you'll probably want to go, let's say, up to 10, right? If you could afford $15,000 worth of that stock, that might be acceptable for you. So maybe I'll just do 10 in this case. And the last traded price on this contract today was 30 cents. So I'd love to be able to get filled at that tomorrow, but I'd actually be willing to accept it at 25 cents. Because again, I'm going to assume this is not going to fall 50% in just 1 week's time. And you can see there's tons of open interest on this strike as well. Over 1,100 contracts in open interest, 900 contracts alone were trading today. So this is a very liquid security for those of you that are concerned about that sort of thing as well. So I'll go ahead and click the confirm and send button. I'm basically saying put $250 in my account tomorrow for my willingness, if it comes to it, a week from today to sell this stock, or I mean to buy this stock 50% off from where it's currently trading, in this case at $15 per share. Let's go ahead and send that off, and we'll see if we can get filled first thing in the morning. Thank you so much for joining me here today. Remember, if you got value out of this video, we would encourage you to go over to Twitter and click like for us. There's 4 different ways you can actually do it. You can either go and find it pinned to the top of my timeline. You can click on it in the email that you would have received from us, where there's a little Twitter icon. You can also look in the description area of the YouTube video itself, and you can click that little like button just directly below when some of you are watching it on our website. So a lot of different ways to interact with us there. We really appreciate that. David will be back on with you tomorrow. Until then, I want to wish you all the best of success with your trades and your investments. Goodbye for now.